well, if you want context to this video, I want to quickly show over here. I did a YouTube video 2 weeks ago called "The Three Signals That Always Happen Before Market Correction," and great little video for you to all get a really good grasp on what we're going to be talking about today. So let's dive into it. Here's the chart of the S&P 500. Now, we were talking about that before, that this has been the longest and the largest in magnitude rally this decade, 100 percentile, without a 5% correction. So we've been going essentially since the Liberation Day lows. We went 38% over 186 days. It was an epic rally on the upside. But for weeks, we've been just saying, look, the bulls are in control, higher highs, higher lows. The trend is very, very clear in the bulls' favor, but it was ninth inning dynamics. There was simply the asymmetry was not in favor because the upside potential versus the downside risk was not in your favor. And inevitably there was going to be a correction. So let's talk about, we definitely started a correction. So right now we had a peak to trough little 1 day market drop that was 4%. It hasn't met the 5% criteria that we like to anchor off. So we haven't officially even labeled this a 5% correction. More importantly, all pullbacks have been held by the 50-day moving average. So we can't write off the bulls yet. The bulls could, in theory, save the day off of this moving average. This was just a quick retracement, and they could rip it right back to its highs. But there's a lot of things going on from an intermarket perspective that simply cannot be ignored. Let's go through them all. Okay, first of all, I want to obviously, this is the focal point for the trigger. It was Trump, and so every single tweet about China, whether the meeting is still on, the meeting's off, 100% tariffs on, 100% tariffs off, all this is just causing substantial market gyration. But there are things that you need to understand. Things like, for instance, volatility is rising. The markets now have hundreds of billions of dollars of systematic traders. Those systematic traders, whether they're vol targeting funds, whether they're CTAs, or whether they're simply dealers that are now taking the delta hedging of their portfolios for all of these options being utilized in the portfolio. Whichever way it is, they're systematically having to buy and sell. So this isn't an emotional decision. There are people looking at the fundamentals. They are going to have to sell if certain triggers are met. And so what are those things? Well, first of all, vol targeting funds are about realized volatility. Now, implied volatility here, I'm just going to use the VIX. Actually, here, let me just do it on this chart. The volatility for the month of August and September was hovering around 15% on implieds. Well, you can see here the jump to 22% over the last week, as now insurance cost of buying downside put protection has jumped. But we haven't yet seen panic in the VIX yet. But elevated levels of volatility are the first sign that those vol targeting funds, which have literally been buying for 4 months, because when the Liberation Day super huge realized volatility started to roll off about 3 months after for 90-day vol, they all started to being forced to lever up and do all the buying, and that buying has been dominating the market for a while. But now, if volatility returns, they're going to reverse and they're going to start selling. The second thing is that CTAs, many of them have different proprietary ways of trend following. But generally, what I have found is that almost always their signals start coming when the market starts spending time below the 50-day moving average. Are we below the 50-day moving average? No, but that is such a huge line in the sand, because those systematic traders are going to start to sell if we start seeing any sustained period below there. More importantly, all these people grabbing at these S&P put hedges will put the dealers in a potential position where if the selling intensifies, they will need to be shorting into weakness in order to stay delta neutral. This is the feedback mechanism that can create those air pockets of downside volatility where things turn violent. Now, will it happen? Well, again, what you can observe is that we've had two trips below 6,600 right here. And each time the market recovered relatively quickly. This becomes a really easy line in the sand for all of you to watch, because if the bulls are keeping it above here, this means that the market, while it's seeing stress cracks, it hasn't fallen off the edge of the cliff for there to be a big downside move. Now, I want to remind everyone, using the topping formation that happened before Liberation Day, I want to highlight here that this entire topping formation right here took like 3 months. And what I want to observe is that these drops, like look at this first drop here that happened back in December around Christmas, was about a 4 to 5% drop that happened quickly. But look what followed. The market rapidly rallied back above the 50-day, then sold, rallied again, sold, and then finally another full rally that went for a double top retest of the highs. This is what we call a distribution level, which is essentially the market isn't bearish, but it's no longer bullish, and smart money starts selling into strength. And so the question here, are we going to see this pattern emerge here right now? Are we going to see that every rally here that gets bought on dip is immediately met with selling and distribution along the highs? That is 100% the thing to watch. There's always possible we double top retest or have short-term rallies. Like for instance, on a 4-hour chart, what you can basically observe is that almost all of these rallies here are just failing right along their Fibonacci zone so far, even though each one of these is a one tweet from Trump away from a swing higher or lower. But generally, this market is still vulnerable for another leg down on these 4-hour charts, maybe even 6,400, making it very clearly a 5% correction underway. What could happen if this turned ugly? Now, again, I like as a trader to just be prepared for different scenarios, hedged out, and sort of have a game plan or a framework for understanding what would happen. Well, if we start spending any time below 6,600 and these triggers start to happen in the markets, a very good baseline correction would be about a 50% retracement to a 61% retracement of the entire rally. And what you can observe here is that a 50% retracement from peak to trough would be about a 13% sell-off, and a down to the 61.8 retracement, it would be about a 17% sell-off. Now, excuse me, I'm not necessarily forecasting that we're going down there, but if the selling intensified and we saw a kind of an air pocket drop, those would be levels of high interest to me if things started to intensify here. So in addition to that, what I'm going to be watching for is the other intermarkets and the way that they're behaving. So what I want to watch for, will the dollar maintain its strength? Will the market breadth remain weak? One of the things I talked about in that other YouTube video was the deterioration in market breadth. Well, we're now down to 40% of the market breaking down here. And so we're basically at a stage where this breakdown is demonstrating deterioration. The other thing to observe is that, excuse me, the volatility index is stay above the 20 level. This is going to be also a very big tell, because elevated levels of volatility create that feedback mechanism. The other things that I'm watching are going to be junk bonds. What we saw was that the junk bond market was been in an epic rally, basically running here. I'll do it on the candlestick charts. And what you can observe here is that we had such a clean bull market throughout the last 5 months. And now what we're seeing is the first legitimate breakdowns. Will we see credit markets actually confirming almost every stock market correction that was at least 5%, sorry, 10% or more, had the credit markets also breaking down? So will we see a breakdown in the HYG here is going to be something that we're watching very, very closely. The other thing is that will we continue to see a risk off dynamic with money flows going into long term treasuries? There's a lot of people that have been bearish the long bonds, but they've been behaving very bullishly, including if you look here on the SOFR futures, continue to uptick, suggesting that the Fed may be actually easing even more. All of these things are the warning signs that the situation is deteriorating even more. Anyway, that's, I think, enough for today. What we're going to do here is we'll keep all of you up to date. The key to watch the 6,600 level. If it really starts breaking below there, then we're going to see what kind of a negative feedback loop ensues there. We'll keep you up to date all throughout the week. Have a great one, everyone.